Hey people, what's going on? Welcome back to the channel. Hope you're well and in good health. Let's dive in here. Right now we're on an article in the Financial Times and it says basically the Bank of England is expected to raise interest rates to 5.5%. Obviously it's a big increase over the last several months when it was pretty much near zero and it's slowly been increasing. Now it could get to 5.5%. So let's take a deeper dive and find out what's going on. Financial markets and economists are expecting the Bank of England to raise interest rates by another quarter point at its meeting on Thursday, right? A couple of days away from now, taking the cost of borrowing to 5.5%, highest level since early 2008, which was basically the previous global meltdown, the financial crisis that we came across previously, right? So the rise would follow a similar move from the European Central Bank last week, despite comments from BOE rate setters over the past month that were designed to give them the option to hold rates at 5.25%. So it's a quarter of a percent increase you're looking at here. Now, the near certainty among economists and financial markets reflect the BOE's guidance that they would raise rates again if there were further signs of persistent inflation. Obviously, that's worrying because why they're raising it looks like they are being on their guard against inflation. Now, obviously, inflation increases the cost of pretty much everything. So, which have been seen in the latest wage and cost of services data. Although wages have been rising, unemployment has also been rising, and obviously inflation is quite high as it is. Now, this evidence jars with the signals coming out of Threadneedle Street in recent weeks. Now, many members of the bank's Monetary Policy Committee have sought to create some doubt over the September decision now that borrowing costs are sufficiently high or bear down on economic growth and inflation. BOE chief economist Hugh Phil said inflation would fall if the BOE raised interest rates further and then had to cut them as financial markets expect, or if the BOE paused and kept them at current levels for an extended period. He said B tended to favour the latter. Right? Giving evidence to Parliament, BOE Governor Andrew Bailey and his deputy Sir John Cunliffe agreed that interest rates were much needed at the top of the cycle. Obviously, that might be a little bit of good news, but it's still quite high and it's affecting a lot of mortgage holders, those of you who are on the rental markets, landlords who have properties in terms of buy to let mortgages and so on. Now, a fourth MPC member, Swati Dhingra, indicated she thought interest rates had already risen too far and there was a serious risk of over tightening. Okay? Even though four of the nine MPC members expressed views that they were not certain rates needed to rise further, economists said that data since the rate setters meeting in early August had been too inflationary for the BOE to pause immediately. Now, private sector wage growth of 8.1% in the year to July and services inflation of 7.4% were both well above the BOE's forecast in August. Now, but the 15th rate rise in the cycle could well be the last. Paul Hollingsworth, chief Europe economist at BNP Paribas, said he expected a dovish hike to 5.5% alongside guidance that the majority of the committee now thought rates probably did not need to rise further. Also, capital economists said a quarter point rise would be the last in the cycle, while Deutsche Bank said that after the BOE raised rates to 5.5% on Thursday, the door for pause is open. So potential there that it could stop here for now. Financial markets have moved to take the same position. At the end of last week, they were still pricing in a quarter point rise in rates on Thursday and viewed this as the peak for now. In contrast, after the MPC's August meeting, markets were still expecting rates to reach 5.75% this year. That would obviously be a double increase of a quarter percent. Now, Krishna Guha, vice chair of Everco ISI, said that although there had been a coordinated effort to persuade everyone there was no need for many more rates rises, the data did not yet justify a pause. Interesting. Now, the big unknown for economists both inside and outside the BOE is the August inflation data, which will be published probably tomorrow and that's one day before the rate decision by the Bank of England is announced. The rate of price growth stood at 6.8% in July and expected to tick higher to about 7.1% as a result of rise in petrol and diesel prices last month, as well as the increase in duty on alcohol drinks. Now, the slight rise in inflation is unlikely to concern the policymakers because it was the bank's August forecast, but the MPC will be watching the trend in the services sector in terms of data quite closely. Right, the central bank views price growth of domestic services, especially areas such as restaurants and hotels, i.e., the hospitality industry, as a strong guide to underlying inflationary pressure. Inflation in the area has been rising steadily, and it would take a sharp improvement in the August data for MPC to vote for a pause. Other developments in economic data over the past month are likely to be glossed over by the NPC, economists said. They said that the revision that showed the UK economy performed almost 2% better than previously thought in 2020 and 2021 combined were unlikely to change the NPC's view of inflationary pressure. Now, Andrew Goodwin, chief UK economist at Oxford Economics, said the upgrades were more likely to change policymakers' view of how fast the economy could grow without generating more inflation rather than make them think that there were greater pricing pressures this year. It's not clear that the revisions will affect MPC's stance on interest rates, he said. So you can see obviously potential now for the interest rates to go up to 5.5% in a couple of days' time. Like I said, it is going to affect a variety of people, such as those who have mortgages, in terms of people who bought properties. Those looking to buy properties, obviously getting on the ladder will be more difficult due to the interest rate and the mortgage rates, as well as, for example, landlords. Those who own properties have buy-to-let mortgages where the prices will increase in terms of monthly payback that they need to do to the banks. Okay, people, please do like, share, subscribe, comment below. Let us know what you think about this potential interest rate rise, and let us know about the issues you're facing in the current economy wherever you are in the world. Okay, people, catch you in the next one.